Welcome to the world of public sector accounting. Think about your local government or national public services. They handle a lot of money, your money, as taxpayers. So it's vital they report their finances clearly and honestly. This is where International Public Sector Accounting Standards, or IPSAS, come into play. IPSAS are a set of accounting rules designed specifically for public sector bodies. Their goal is to improve the quality and comparability of financial information reported by public sector entities around the world, leading to greater transparency. Public sector entities operate differently from private companies. Their main aim isn't usually to make a profit. Instead, they focus on providing services to citizens. Standardized accounting helps everyone understand how these public bodies are managing their financial resources. It allows citizens and oversight bodies to hold them accountable. The International Public Sector Accounting Standards Board, IPSASB, develops and issues IPSAS. Many countries and organizations worldwide are adopting or aligning with IPSAS. This global movement towards IPSAS helps build trust in public financial management. When governments use these standards, their financial statements become more credible. Now that you have a basic idea about IPSAS, let's zoom in on one specific standard. We are going to talk about IPSAS 36. The full title of this standard is Investments in Associates and Joint Ventures. Public sector entities sometimes invest in other organizations. IPSAS 36 provides the rules on how to account for these specific types of investments. It helps ensure that these investments are reported correctly in the financial statements of the public entity. The scope of IPSAS 36 is quite specific. It applies to accounting for investments where a public sector entity has significant influence over another entity, an associate. It also applies when the public entity has joint control over an arrangement with other parties, a joint venture. Correctly identifying whether an investment falls under IPSAS 36 is a crucial first step for accountants. The primary objective of IPSAS 36 is to prescribe the specific accounting treatment for investments in associates and joint ventures. To truly grasp IPSAS 36, we need to understand its main characters, associates, and joint ventures. Let's start with an associate. An associate is an entity over which the investing public sector entity has significant influence. It's important to distinguish this from a subsidiary. A subsidiary is an entity that the investor controls, usually by owning more than 50% of the voting power. With an associate, the investor doesn't have control, but they do have a strong voice. Identifying an associate correctly is key to applying IPSAS 36 properly. Next, let's look at a joint venture. A joint venture is a specific type of joint arrangement. In a joint arrangement, two or more parties have joint control. Section 4. The Equity Method. Accounting for significant influence. Once a public sector entity identifies an investment as an associate or a joint venture, IPSAS 36 generally requires the use of a specific accounting technique. This technique is called the equity method. The equity method is the cornerstone of accounting for these types of investments. It's used because it reflects the investor's ongoing economic relationship with the investee. It acknowledges that the investor has a vested interest in the investee's performance, not just a passive holding. So, how does the equity method work in practice? Initially, the investment in an associate or joint venture is recorded at its cost. After the initial recognition, the carrying amount of the investment is adjusted to reflect the investor's share of the investee's profits or losses after the date of acquisition. This method provides more relevant information to users of financial statements than simply keeping the investment at its original cost. Section 5, IPSAS 36, in practice. Simple examples for clarity. Let's bring IPSAS 36 to life with some practical examples. Imagine a city council decides to invest in a local energy company. The city council purchases 30% of the shares of Green Energy Corp. This shareholding gives the city council a seat on Green Energy Corp.'s board of directors. The city council can participate in making important financial and operational decisions for Green Energy Corp, but it doesn't control the company. In this scenario, Green Energy Corp would be classified as an associate of the city council. The city council would then need to apply the equity method to account for this investment. Suppose Green Energy Corp has a successful year and reports a net profit of $1 million. Since the city council owns 30% and has significant influence, it would recognize its share of this profit. The City Council would record $300,000 or 30% of $1 million as income from its investment in associate in its own financial statements. This increases the carrying amount of its investment in Green Energy Corp. Later, if Green Energy Corp decides to pay out $200,000 in dividends, the City Council would receive $60,000 or 30% of $200,000. This dividend received would reduce the carrying amount of its investment in Green Energy Corp. Now let's consider an example of a joint venture. Suppose two neighboring regional governments, Region A and Region B, decide to collaborate. Section 6. Shining a light disclosure requirements under IPSAS 36. Accounting standards are not just about how to calculate numbers, they are also about providing clear and sufficient information to others. This is where disclosure requirements come in. IPSAS 36 mandates that public sector entities provide specific details about their investments in associates and joint ventures in the notes to their financial statements. These disclosures are vital. They help users of the financial statements, such as citizens, lenders, and oversight bodies, understand the nature and financial impact of these investments. For investments in associates, IPSAS 36 requires several key pieces of information to be disclosed. The public entity must disclose the name of the associate and the nature of its relationship with the associate. It must also state the proportion of ownership interest or participating share held. Importantly, summarized financial information for the associate should be provided. Section 7, the big picture, why understanding IPSAS 36 benefits everyone. Let's take a step back and look at the bigger picture. IPSAS 36, with its focus on investments in associates and joint ventures, plays a significant role. Its main purpose, as we've discussed, is to ensure that public sector entities account for these specific investments in a consistent and meaningful way. This is primarily achieved through the application of the equity method. By doing so, the financial statements provide a more accurate reflection of the entity's financial position and performance. This isn't just an academic exercise, it has real-world benefits. For public sector entities themselves, understanding and correctly applying IPSAS 36 brings several advantages. It leads to more accurate and reliable financial reporting. This, in turn, helps public managers gain a better understanding of their entity's financial involvement and exposure related to these investments.